Here's how you can buy a house with very little money down and credit scores as low as 500. It's called an FHA loan. And in today's video, we're going to go over the 2024 FHA loan requirements, along with answering some questions about FHA, as well as show you some basic FHA calculation when it comes to calculating mortgage insurance. Now, something I want to be very clear on early in this video is FHA loans are not just for first-time homebuyers. There's this myth out there that only first-time homebuyers can use an FHA loan, and it's simply not true. In fact, anyone can use an FHA loan, regardless whether you're a first-time homebuyer or someone that's owned multiple properties. In addition to that, it's also not for buyers with just low credit scores or those buyers with very little down payments. Yes, it allows lower down payments and lower credit scores, but you can have credit scores as high as 800 and be able to put 20% down and still use an FHA loan. And that's exactly what we're going to talk about in today's video. The primary reason we're talking about FHA versus talking about a conventional loan or a VA loan or a USDA loan is because FHA has the most flexible guidelines out there with regards to qualifying when it comes to buying a house. And that's because they do allow lower credit scores, they do allow lower down payments, and they allow one of the higher debt to income ratios when it comes to qualifying for a loan, which means they allow you to have more debt and typically qualify for more home when you use an FHA loan. So with that, one of the very first things I want to talk about in today's video is credit scores, because credit scores and FHA kind of go hand in hand. Most people see that they allow credit scores as low as 500 and they think, hey, I have a 500 or I have a 550, I've got to use an FHA loan. So let's talk a little bit about what FHA allows and what you need in order to meet those requirements. So yes, they allow credit scores as low as 500. But the caveat with the lower credit scores is that you need more money down, because FHA allows a minimal down payment of just 3.5%. But in order to qualify for that 3.5% down payment, you need a credit score of 580 or better, which means if you have a credit score lower than 580, then you have to put at least 10% down in order to meet the FHA loan requirements. So in summary, between 500 and a 579 credit score, you need a minimal down payment of 10%. And above a 579, so a 580 and above, you can get away with as little as 3.5% down. Now, this is where I typically like to go into a little bit more detail, because people hear what I just said and say, I have a 579, I have 10% down, I can use an FHA loan. Well, maybe. But understand, the lower your credit scores, the harder it's going to be to qualify for an FHA loan, or really any loan for that matter. So just because you meet the credit score requirement and the down payment requirement doesn't necessarily mean you're going to get approved for an FHA loan, because there are other things that have to be factored in order for that lender to approve you. And typically with lower credit scores, that loan is going to have to be manually underwritten, which means they're going to take a fine-tooth comb and go through that loan. They're going to look at everything. Versus when you have the higher credit scores, yes, they're still going to go through the file with the fine-tooth comb, but they're probably not going to nitpick it quite as much as those files that have to be manually underwritten. So a moment ago, we talked about the down payment requirements with regards to the credit score. So most people looking at FHA loans are typically going to put the 3.5% down option, assuming they qualify for it. So what does that actually mean? That means if you're buying a $100,000 home, your down payment requirement's only $3,500. $200,000 home, $7,000. A $300,000 home, $10,500. A $400,000 home is $14,000, and a $500,000 home is $17,500, and the list goes up from there. Now, with that said, FHA does have loan limit requirements, so depending on where you're located in the United States is going to dictate how high that loan limit is. If you're in a low-cost area, the loan limits are going to be less than those living in a high-cost area. So if you're living in an area, say like Southern California, where we are, that's a high-cost area, versus say the middle of the country, well, most of those areas are going to be low-cost areas. Now, if you're watching this video wondering whether or not you live in a high-cost area or a low-cost area, there's actually a link in the description below from HUD where you can go check your zip code to go find out what the exact loan limits are. In fact, the loan limits for FHA typically get updated every year, and because I'm filming this video prior to those loan limits being updated, I'm not going to throw them on the screen. Rather, I will put them in the comment comments below so that you can see what the new updated loan limits are. Now, one thing to understand when it comes to those loan limits is that if you're trying to purchase a home that is higher than that loan limit that FHA is willing to lend you, you can still use an FHA loan. You just have to put more money down in order to meet those loan requirements, which typically in my experience means most people aren't going to use an FHA loan unless they can use it to its full benefit, which is by financing just using 3.5% down. Now, one other thing I want to mention when it comes to the down payment requirement is mortgage insurance. So FHA often gets a really bad rap when it comes to mortgage insurance because there's a lot of people on the internet saying you should never buy a home unless you have 20% down so that you can avoid mortgage insurance, or I would never buy a house and have mortgage insurance. And the reality is mortgage insurance isn't really that bad. It's the cost of doing business. Unless you have the opportunity to put 20% down, you're going to have mortgage insurance on your loan, regardless of what type of loan you do, whether it's FHA and or conventional. So unless you have that money to put down, then you don't really have any other options. Therefore, mortgage insurance isn't really a bad thing. But with that, FHA made a change a couple years back where they made the mortgage insurance on the FHA loan for the life of the loan. So regardless of how much equity you get in that property, you're going to have mortgage insurance on that loan when you do the 3.5% down option. Now, if you put 10% down when you buy that home, then the mortgage insurance on an FHA loan will fall off after year 11. But as I mentioned earlier in the video, most people getting an FHA loan are typically doing the 3.5% down option. That's one of the big benefits of the loan. Therefore, if you use that option, then the mortgage insurance is going to be on that loan until you either pay that loan off or you refinance out of that loan into another type of loan. And that's one of the questions that often comes up when talking about FHA is, hey, can I refinance out of this FHA loan into a conventional loan at some point in the future? And the answer is absolutely, assuming you qualify for that other type of loan. So you can go with an FHA loan to start, hopefully build some equity up in that property, pay down your principal balance, and at some point hopefully refinance into a conventional loan where you don't have mortgage insurance. Now, a little bit later in this video, we're going to show you how to actually calculate what that mortgage insurance payment is going to be every single month. But before we do that, I'd like to take a minute and ask a favor. If you find any value in my videos at all, do me a favor and hit that thumbs up. It helps the YouTube algorithm push it out to more people like you. And also do me a favor and subscribe to the channel to stay updated on everything FHA, mortgage, and real estate related. Now, earlier in the video, I mentioned FHA being the most lenient, the most flexible when it comes to loan programs out there because they allow a higher debt to income ratio. Now, a lot of people don't truly understand what debt to income ratio is, so I want to take a minute here and break it down. It's really simple. It's your debt, your monthly debt that reports on your credit report versus how much income you make. Now, what it doesn't include is things like your cell phone bill, things like your utilities, your groceries, your childcare, that sort of thing. That's not factored in to your debt to income ratio. Now, it should be factored into your budget, but it doesn't come up when actually talking to a lender and qualifying for a loan. So the things that are going to report are the things that show up on your credit report. Things like installment loans, things like revolving debt, like car payments, credit cards, things like student loans. Those things that report on your credit report are tallied together in a monthly fashion. So whatever the minimum monthly payments are, you're going to add all those together and you're going to divide it by your total gross monthly income. And that's going to give you your debt to income ratio, your back end ratio when it comes to qualifying for a home. Now, when it comes to FHA, the reason they're so lenient is because they allow a 47% front end ratio and a 57% back end ratio. Now, what are the difference between the two? The front end ratio is just your housing expenses. So anything related to the mortgage payment on that house. Not housing expenses like electric and utilities and gas and any of that sort of thing. That's not included. It's your principal, interest, taxes, and insurance. So it's your mortgage payment plus your property taxes, plus any homeowner's insurance, any HOA fees, that sort of thing, all added together. That's your housing expenses. So that's your front end ratio. And then your back end ratio is all of those things that we just talked about, plus those other debts that you had, like your credit cards, your car payments, your student loans, that sort of thing. Now, if you have no other debt, and you just have your housing expenses, then your front end ratio and your back end ratio are essentially going to be the same. But let's do a quick calculation here to give you an idea of how this works. So let's say you make $120,000 a year because it's an easy number to calculate for a video like this. So $120,000 a year is your gross monthly income. That's before any taxes are taken out. That's the number that the lender uses. Now, a lot of people ask why? taxes are taken out of my check. I don't bring that amount home. Well, it's because everybody's expenses are calculated a little bit differently. A lot of people have different deductibles than one another. Some people get money taken out of their check for medical, for 401k, for different distributions. Some people have garnishments on their wages. So the numbers can be a lot different for a lot of people. So what they use is your gross monthly income. They assume that you're going to create your own budget and be able to base your monthly payment off what you're comfortable with. So for this video, $120,000 is the gross monthly income. What we do is we divide that by 12 because that's how many months are in a year, and that breaks down to $10,000 per month. So that's the income that we're gonna be using for today's video. Now the second part and the more difficult piece to calculate here is the debt part, because that's the amount we're gonna divide into that income. Now, the reason this is difficult to calculate is because most people don't have a true copy of their credit report, right? They don't know what shows up on their credit report. They just have an idea of what their expenses are, and a lot of their expenses might be different than what shows up on their credit reports. So we'll talk about that here in just a minute, but let's just say for today's video, you have a $500 car payment and you have $500 in credit card payments that you make every month, the minimum payment. Let's just say you have 5 credit cards and they all require a $100 minimum payment per month. So that's $500. You got a car loan of $500. That's $1,000 per month in monthly debt. So we know your debt piece now. So now we got to figure out what your housing expenses are. So in today's video, let's just say that your housing expenses are $3,000 per month for your principal interest, and that you pay $500 for taxes and then insurance, and say there's an HOA of another $500. So let's just say your housing expenses are $4,000 per month. Well, in order to figure out your front end ratio, which needs to stay below 47%, we have your housing expenses, which are $4,000 per month. We divide that by the 10,000. That gives us 0.4. We multiply it by 100%, and that gives us 40%. So we know our front end ratio meets the requirements for FHA. But now we need to factor in the back end ratio, right? So now that's the total front end ratio of 40%, or $4,000 in this case, and we need to add that $1,000 of debt. So that's $5,000. So we take that $5,000, we divide it into the total monthly income of $10,000. That's a back end ratio of 50%. So now we know our front end ratio is 40%, back end ratio is 50%. So in theory, that meets the guidelines for what FHA requires in order to meet their guidelines. But here's what I want to say. This video is for novelty purposes only. Don't go and try to calculate this stuff on your own, because what can happen is you can calculate it and say, hey, yeah, I meet all the requirements, I'm good to go. And then you go out and try to buy a house and you never actually talk to a lender. Please don't do that. Instead, maybe do some calculations on your own and figure out whether you think you qualify. But before you make any decisions or do anything or decide whether or not you can or can't, call a lender and have a conversation. Let them run the numbers and tell you whether or not you meet the guidelines. And don't try to figure this out on your own, because you can end up putting yourself in a bad position. Now, if you're watching this wondering, where do I find a lender? How do I find someone to talk to? I've put a link in the description below of people I know, like, and trust that can guide you through that process. Now, you don't have to use one of those people. You can go into your bank. You can call a friend who got a loan that you know did a really good job and get a referral. A referral is always a really good source to start. And you can go that direction as well. But what I would recommend, even if you go my route and you use that referral link below, still go into a bank or talk to someone that you know that does loans and get a comparable quote. Or in the instance that you start with one of those other people, use the referral link below and compare the quote that you got, just to make sure everything's on the same page. All of this stuff should be free. It shouldn't cost you any money to do it. Therefore, you should use it just to make sure you're getting a competitive quote with competitive fees and that you're not getting overcharged. In fact, sometimes you can go into your bank and your bank can say, you don't qualify. And that's primarily because some banks out there have overlays on their program. So even though you meet the basic guidelines of FHA of what they require, that bank may have overlays on their programs and not allow credit scores, say, below a 640. Even though you can qualify with your credit score, the bank may not do it. Whereas going to a broker that has access to that bank, as well as many others, might have a lender out there that will actually do it with those lower credit scores. So when you're going through the pre-approval process and you're trying to figure out whether or not you qualify, it's always super important to work with a professional in addition to getting a referral that you can trust. And the last time I'll say it is that referral link below can get you to one of those people. Now, there are some additional requirements like the type of property, as well as income and employment guidelines that we're going to talk about here with regards to FHA. But before we do that, one of the questions that often comes up when talking about FHA is, what are the interest rates for FHA loans? Well, typically interest rates for FHA loans are usually better than that of conventional loans, especially for buyers with lower credit scores and lower down payments. It usually ends up being a better loan all the way around, but you also have mortgage insurance that you have to factor in on top of that interest rate. Now, the nice thing about FHA is that the mortgage insurance rate is more or less going to be the same for most buyers out there, especially if you're putting just 3.5% down. In fact, it's going to be the same for any buyer out there, regardless of credit score, when you're using that 3.5% down option. And that mortgage insurance is 0.55%. And you're probably watching this going, Jeb, what does that actually mean? Well, let's do a quick calculation here so that we can help you figure out what that mortgage insurance is. Now, for today's video, we're going to use a purchase price of say $350,000. So in order to purchase that home, assuming you have a credit score above 580, you just have to put 3.5% down. So what we do is we take $350,000, we multiply that by 3.5%. That gives us $12,250. So what we're going to do is we're going to actually deduct that from the total purchase price, which gives us a base loan amount of $337,500. Well, one thing about FHA that you need to be aware of is that FHA has something called upfront mortgage insurance. It's required on every single FHA loan, regardless of down payment, regardless of credit score. It doesn't matter if you've had one or if you've had 10 different FHA loans, you're going to have upfront mortgage insurance. And it's the same rate for everyone. It's 1.75%. And there's absolutely no way to get around it. Now, you can pay it out of pocket through the close of your loan, but most people choose to finance it, which basically means when you're putting just 3.5% down and you're financing the other 1.75%, you're essentially losing half of your down payment to start within that property because of this upfront mortgage insurance. But what we're going to do is we're going to take that $337,500 and we're going to multiply it by 1.75%, which is going to give us a new base loan amount of $343,660. So all of our calculations are going to be based off that new base loan amount. So earlier in the video, I mentioned that mortgage insurance is 0.55%. So what we do is we take that $343,660 and we multiply it by 0.0055 or 0.55%, which is going to give us an amount of $1,890.13. Well, that's actually the yearly amount. What we have to do is divide that by 12 to figure out how much it is per month, which gives us a monthly amount of $157.51. So that's how much mortgage insurance you would pay on a $350,000 purchase, putting just 3.5% down. In fact, you can use that same calculation on whatever purchase price you're trying to purchase in order to figure out how much that monthly mortgage insurance is. But as I mentioned earlier in the video, use this for novelty purposes only. Don't use this as the gospel. Instead, make sure you're talking to a mortgage professional using that link below to make sure you're getting accurate information. Now, we've talked about credit score, we've talked about down payment, we've talked about mortgage insurance, debt to income ratio. We showed you how to calculate mortgage insurance. Now we need to talk about the types of properties that FHA allows. So FHA only allows you to finance a primary residence. That's a home that you're going to live in. If you're looking to buy an investment property and not occupy any piece of it, FHA is not going to allow you to finance that property. Now, with that, one question often comes up. Can I buy this property as my primary home and turn it into a rental at some point in the future? And the answer is yes. While there's actually no required time that you have to live in that property in writing anywhere in the FHA guidelines, most people say that you need to live in the property for around a year as your primary home before you turn it into a rental. Now, with that, there is a caveat or a loophole, if you will, when it comes to investment property. If you buy a multi-unit property, say a duplex, a triplex, a fourplex, you can actually live in one of the units and rent the others out as an investment property and use an FHA loan. And the nice thing about FHA is that you can still get away with just putting the minimal down payment, 3.5%, all the way up to 4 units. But here's the thing, I'll be completely honest with you. If you live in a high cost area like Southern California, it's going to be very, very difficult to buy 3 and 4 units with just a minimal down payment because FHA has something called a self-sufficiency test, which is another loophole, another guideline that you have to jump through when it comes to financing units with a minimal down payment. Now, if you buy 1 unit and or a duplex, that's 2 units, then you don't have to worry about that self-sufficiency test. You can get away with just 3.5% down. Now, people often ask me, Jeb, you said units. What are units? Well, it's when there's multiple doors on a property. Say, for example, you pull up to a house and there's 2 different entrances for 2 different properties. That's typically a 2-unit property. Or in some cases, there's 2 houses on one lot. that's usually a duplex. That's 2 units on a property. And the same goes for 3 and 4 units. It's usually a building that has 3 different residences within that building. That's a 4-unit property. Now understand, there are areas of the country outside of Southern California where you can get away putting just 3.5% down and buying units. But unfortunately, if you're in one of these higher cost areas, it's going to be more difficult. And also something to note when it comes to the loan limits that are mentioned below, as you go up in units, the loan limits actually increase as well. And that's how you can get away with the 3.5% down with buying higher priced property. So if you're interested in trying to house hack or buy multiple units, just make sure you're running it by your lender when you're going through that pre-approval process. Now, one other thing I want to note when it comes to buying your primary home, FHA has a requirement where that property has to meet basic FHA loan requirements, if you will. Now, if you buy a single family home, typically you're in pretty good shape. It doesn't have to really be an approved single family home. In fact, all single family homes are approved with FHA. Now, FHA does have some requirements that it can't have things like peeling paint. It has to have a working heater. It has to have appliances in the property. It really can't have any health and safety violations going on in order for it to qualify for an FHA loan. But most of the time, most properties will qualify for FHA. So that's not really an issue. It becomes more of an issue when you're trying to buy a condo using an FHA loan, because all condos have to be on the FHA approved condo list. And while many of them out there are, a lot of condo complexes haven't gone through that process of getting FHA approved, which means if you want to buy one of those properties that's not on that list, then you either have to do a spot approval to try to get that unit approved, which can be a long and lengthy process, or you have to find another unit because FHA will not lend on it unless it's approved. Now, with that said, I actually put a link in the description of this video below where you can actually check different condo complexes to find out whether or not they're FHA approved. In addition to that, if you don't see the condo list on the approved list, what I would recommend is talk to a realtor in your area, ask them if it's approved, because they can go into a little bit deeper search. Because what I will say is sometimes it can be difficult to find out whether certain condo complexes are approved because of how they're named within the system. So just make sure you're talking to a professional that knows that market where they can do a little bit more research. And one of the last things I want to talk about when it comes to FHA loan requirements is income and employment. Now, this is 2 things that people often have a lot of questions about. So I just want to talk about some basic guidelines here. And then what I'll do is I'll actually link to a video here where you can go and get a little bit more information on this. But you have to more or less have a 2-year history of working within the same line of work. Now, there's a lot of questions around that. What I will say is that typically you don't want gaps in your employment. Yes, you can have gaps, but you don't want a lot of gaps in your employment, and you need to be working steady for 2 years, making consistent income. And one of the examples I often use is that if you're a server, say that you're a hostess to start with, and then you become a server and you've been there for 2 years. That's the same line of work, even though the positions were a little bit different. With that, you should be good. So what you don't want to be is a hostess of a restaurant where you're getting a W-2 salary, a salary every single month or a paycheck every single week, and then you go out and become a loan officer, a commission job where you're getting a W-9. You're essentially self-employed because you went from a wage earner to a self-employed job and you don't really have a history of it. That can become a problem. So if you've been in the same line of work, doing the same thing, then you should be in good shape. And the same thing is for your income. If your income fluctuates a lot all over the place, then that can be a problem. But if you're getting steady bumps in your income's growing consistently over time, then you're in good shape. And the same thing can be said is, say if you had your income at say 50,000 and it dropped to 45,000, now it's 55,000. That's pretty consistent for the most part. But what I would say, just like I said earlier in the video, don't try to figure this out on your own. Make sure you're talking to a professional and letting them actually analyze the income to determine whether or not you qualify. Qualifying for a loan when you've had a bunch of different changes in employment can sometimes be very, very difficult. So you want to make sure you're having a professional look at it just to make sure you're in good shape and you actually qualify to buy a home before you go out there and start making offers. Now, I know there are other questions that you have when it comes to FHA loans about closing costs and different things. And in order to make this video somewhat timely and not get bogged down in a lot of the details, what I'll do is I'll link below to a couple of different videos when it comes to FHA so you can go through the details of all of the information there. And with that said, the mortgage process is only a small piece of the puzzle when it comes to buying a home. If you're new to this, if you're a first-time home buyer, you're not really sure where to start outside of getting a loan, what I would recommend is my first-time home buyer course. I created it to educate, to make people fully aware of what it takes in order to buy a home from A to Z. So if you're somewhat new to the process, not sure where to start, do me a favor and check that link in the description below. The last thing I want to say about FHA loans is FHA loans are good loans. There's a lot of people out there making videos saying that they're not great loans because of all of these different factors. So what I would say is don't get wrapped up in that. If you're getting a loan, you're going through the pre-approval process, just have your lender give you your options. Have them give you an FHA option, have them give you a conventional option, have them give you other options if you qualify for that option. And then ultimately you make the decision to which loan is the right loan for you. But if you're watching this video, you have additional questions about income, employment, FHA guidelines, do me a favor and check out this video here.